Good morning, everybody. Uneducated Economist here. So in this video, I'm going to try and explain what is happening with the banks right now, because there is a liquidity crisis that is forming. And really, it's very difficult for a lot of people who are new to trying to understand like economics, trying to understand financial systems, and trying to understand what it is that is taking place right now within the economy, especially when you hear a lot about the Federal Reserve and the raising of interest rates, or now recently they're almost inevitable of lowering interest rates. And if you are bouncing around listening to a bunch of information, trying to internalize this stuff so that you can make the best, most appropriate decisions for yourself, it becomes very confusing very fast. So I'm going to try and explain like what it is that is taking place within the banking system right now, because this liquidity crisis that is forming, it's due to the fact that the interest rates are rising and the asset prices are falling. And this right there, this little bit of information, that if you are new to like the bond market or trying to understand how bonds operate, makes this whole thing very confusing if you cannot understand this part of it. Now, most of the people I understand on this channel are probably very familiar with the bond market and how yields go up and prices go down. But if you're new to this part right here just like is the hardest part to kind of grasp, right? But if you don't do it, if you don't understand this bond market and how the operation of like the holdings of these bonds, what takes place within that banking system when those asset prices begin to fall, and then all of a sudden you have a bunch of people who are pulling cash out of the system, this is bad news for the banks, right? And this is exactly what was taking place with Silicon Valley Bank. Okay, all this is very confusing for most people. People who have been following the channel totally get it, but I'm going to break it down for you right now. Now, let's talk about the bond market real quick so that we can understand that particular asset. A bond is a loan just like anything else. That is the easiest way to understand it. You have lent your money to either a corporation or a government or something of that nature, and you are expecting to not only get an interest rate payment, right, but also the principal back on that particular bond, right? So you lend them $100 by buying a $100 bond. It has a 10% interest payment to it, which they generally refer to as the coupon. That coupon is the yield. If you bought it for $100 and it pays a 10% coupon, then it's a 10% yield, right? That all makes kind of sense. So when you purchase that bond as an investor, and you are anticipating that you are going to get a 10% interest payment from it because of the coupon, and you are anticipating that it's going to go till maturity and you'll get your principal back, that is a typical bond, right? Now, you can sell that bond at any time. This is something to try and understand here, because sometimes those bonds become a lot more valuable than the time that you had purchased it. When that takes place, what ends up happening is that you can sell that bond for a profit, right? Before you even take the coupon payment or anything like that, you can sell the bond for a profit. What happens to that investor is the price that they have paid for it will then determine the yield that they get from it, right? So the bond doesn't change. It's still a $100 face value bond. At its maturity, it'll pay the holder a $100 face value, and it has a 10% coupon to it. But if an investor pays a high price for it, the price of the bond goes up and the yield goes down. It's still paying a 10% interest payment, but what the investor is receiving after that bond's maturity, the yield has fallen because of the price that they had paid for it. Does that kind of make sense? So the price of the bond itself is the asset value, right? This is the part that really kind of screwed Silicon Valley Bank, because when they purchased this bond, it had a high price and a low yield. Now, what ends up happening is as the Federal Reserve was raising interest rates and tightening up the monetary system, the financial system, the yields began to rise and the bond prices began to fall. Now, if you have on your balance sheet, right, assets and liabilities, and that asset meets your liabilities, the liabilities is all the cash that you have taken in. Think about this for just a second, because we think about liabilities differently. We look at our debts as liabilities, but the debts to the bank is the asset. The liabilities is all the cash that went out there. So our asset, the cash, right, is the Fed's, or in the banks, the Fed and the banks' liabilities. So this is important to understand, because generally we look at things from a personal point of view and we think, okay, assets and liabilities. Liabilities are the loans, the asset is the cash. From the bank side of things, the liability is the cash and the asset is the loan. In this particular instance, we're talking about the treasury bonds, right? So now, as this asset, right, this treasury bond, as the price of it begins to fall, right, now you have a balance sheet with assets, the treasury bonds, and the liabilities, all the cash that you have out there. These treasury bonds begin to fall in value, right, as the yields begin to rise, and the liabilities you have out there are now offsetting or now outweigh your assets. And this is where Silicon Valley Bank was in trouble, because people started pulling their cash out of the system, which meant that it was an even bigger disparity, as they had even higher liabilities out there and less assets. This is the problem that they were discovering that they were in. So in order to save the banking system from other banks suffering through a complete failure, is that what the Federal Reserve did is they stepped up with something called the Bank Term Funding Program. Now, this is something very important to understand, because it's still in existence today, but it is a very, how should we say it, like, it has a bad stigma to it. Like, if you are a bank that is stepping to the Bank Term Funding Program to get loans to keep your assets in line with your liabilities, you are a bank that is in trouble. So going to the Bank Term Funding Program to get liquidity is a very bad move in the eyes of the market. Like, they look at that as saying, okay, this bank is in trouble. We should probably not be one where they're going to suffer through like something that Silicon Valley Bank had suffered through. Okay. So going to this particular facility to use this is a bad move, right? Now, however, it exists. And this is the important part to understand, is that because it exists, it is now the credible threat that is out there, that the banks now have this ability to do it. So now they can make moves, right, that allow them to try and beef up their liquidity. And if anything should happen, they can at least step to the Bank Term Funding Program to get the liquidity that they need to put their assets back in line with their liabilities. I know this is all very confusing, but we have to understand this stuff in this, I'm trying to break it down in the simplest of forms without getting too complicated, because I've had people tell me very, just recently that I'm just way over their head on a lot of this stuff. But this is important, because what we're about ready to face is the liquidity crisis. And this is because the banks right now will have an issue with that balance sheet offset, right? Their liabilities will begin to rise as their asset prices begin to fall. And if this begins to take place, it makes it very difficult to get loans out there. It makes it very difficult to operate the economy just in general, because of this tightening of the liquidity, right? And I don't know if I can explain it any simpler than that, but the Federal Reserve is in a monetary tightening position right now. A lot of people think that, there's money printer go burr and inflation is going to go on forever. That's not the case. We are moving into a complete opposite, direction when it comes to the economy and the flow of money and interest rates. When they are lowering interest rates, that expands the money supply, right? When they are raising interest rates, that is constricting the money supply. As they are allowing, the Federal Reserve is allowing their balance sheet to roll off, they have put themselves in a position in which that is like being in debt to the Treasury. This is like an even greater concept to try and wrap your head around, because typically the Federal Reserve itself is a money maker for the Treasury. And I know this is like very difficult for a lot of people to kind of wrap their heads around, but they have an operating cost, right? Service fees and stuff like that. Once they have performed their operating cost and whatever, needs that they go through in order to, conduct themselves, whatever's left over goes back to the Treasury. I don't know if a lot of people knew that or not. Well, right now, they're in debt to the Treasury because of the asset prices have fallen on the balance sheet of the Federal Reserve. They are not getting in enough from the Treasury payments on their balance sheet, because during the quantitative easing, they had purchased a bunch of these bonds, put them on their balance sheet. Those bonds are paying them an interest payment, right? But that interest payment that they are paying is not enough for the Federal Reserve to then raise interest rates out there in the banking system. So when the banking system is in depositing money with the Federal Reserve, whether it be from the discount or at the repo facility, or if they are borrowing money from the discount window, right? These particular facilities, or the interest on excess reserves, all these particular facilities are where the Federal Reserve attempts to establish interest rates from. And when it comes to the banking system itself, when it comes to these big banks, how they conduct themselves based on where the Federal Reserve has positioned themselves means that the Federal Reserve has accounts or places in which that these big banks can then place money, right, to find the minimum interest rate place that they could go. Like everything else, it would be the safest place that they could go. Everything else after that would be risk, right? And again, this is kind of difficult to understand, but when it comes to like how it is the Federal Reserve has positioned themselves, is they are now paying out on those particular accounts to the big banks through those particular facilities. They are paying out an interest rate that is greater than what they are taking in from those treasuries and everything else that they have on their balance sheet, the mortgage-backed securities and whatnot, right? So again, this is critical to understand, because they themselves are now operating in the red, right? They owe the Treasury. They are now in debt to the Treasury. And from the article that I'm going to leave down in the description for you guys, it sounds like it's going to be until like 2027, like years from now, before they go back into the black and able to start make up all the payments that they have, all the debt that they owe to the Treasury, right? On top of, the profit that they begin to make or whatever. It's going to take until 2027. Right? This is incredible to think. So here the Federal Reserve is going to be in a very tight position with liquidity, with the balance sheets, with the big banks, all that stuff for years. For years. People who I don't understand, how come I see so many articles out there talking about how the Federal Reserve is about ready to position themselves in a way that is going to start lowering interest rates. That is not the case. Think about it. They are making sure that these banks are sitting on a lot of liquidity, right? They are getting their cash holdings up. They are putting themselves in a position to deal with incredibly tight financial conditions. And if they are not sitting on a high cash position, when those asset prices begin to fall, what we're going to find is that the liabilities are going to begin to rise. And this is going to be a problem. Think about this. If they are not sitting on a lot of liquidity right now, on a lot of cash, if they are not sitting on a lot of liabilities, here, let's put it that way, because you got assets and liabilities. If they are not sitting on a lot of liabilities to offset the problem, because think about it right now, if they were even and the asset prices fall, right? Now their liabilities are now outweighing their assets. They need to get the asset prices up, or they need more liabilities to come in. So this is important to understand. This is why they're building up such a liquidity holdings, right? This is why they're building up a cash holdings. I know this has gotten complicated. I thought I could keep it simple. I can't. It is a very complicated topic, and I don't know. Maybe I'll come back this afternoon and try it again. But this is a very important thing to understand, because the next 6 months to a year is going to be very difficult. It's going to be a very tight economy. It's going to be very tight financial conditions. And it's going to be very difficult for these banks to loan out money, right, at a time when their assets that they hold on their balance sheets are falling. And that's what we're about ready to experience. These interest rates are not going to go down. Right? The Fed is getting prepared for it. The Treasury is getting prepared for it. The big banks are getting prepared for it, but nobody's really talking about it. Right. They're talking about interest rates falling. Nobody's talking about what it's going to be like when interest rates rise. But these big banks are getting themselves into a position to deal with that exact thing. All right, Uneducated Economist, you let me know.